How can you have a reorder quantity 5? You're going to order 5 units? 2 times what? $150 times what? Times what? I don't know. What do you think? Mary, your holding cost is what? 8% per annum. If I say 8% per annum, so your demand must be what? Per annum. It is 8% per annum. So per annum times with what? This is 8% per annum times with your purchase cost, $3 per unit. It's a purchase cost, 8% of your purchase cost. Square root. So how much is it? Hello? $15, 62,500. How you get 62,500? I don't get 62,500. Do you get 62,500? Anybody get 62,500? I don't get 62,500. Come on, people. Yes, 15,000. Thank you, Francis. 15,000 units for what, Francis? For what? Yes, per order. Per order. So what is the total cost? What will be a total cost based on 15,000 units per order? Total ordering cost will be what? Number of orders times cost per order. What will be a number of orders? How many orders are you going to make for one? Why 12 orders? So 180,000 divided by 15,000. So that is 12 orders per annum times $150 per order. So how much is that? 1,800 per annum. Total holding costs. Average stock times what? Holding cost per unit per annum. So how much is it? What's the average stock? Safety stock plus reorder quantity divided by 2. Holding unit per annum. Your safety stock is not given. There's no safety stock. Plus reorder quantity 15,000 units divided by 2 times 8% times $3 per unit. How much is it? Hmm. 1,800 per annum. So you also will include your total purchase cost because there's a bulk discount. You need to compare later. So which is what? 180,000 times $3, which we already have 540,000. So total cost is how much? 540, 600 per annum. Now we look at reorder quantity, 30,000 units per order. Why 30,000? Why do you want to order 30,000? For 2% discount, isn't it? So what is my total ordering cost? What is my total holding cost? If you're gonna order 30,000 units, the formula is the same, but the reorder quantity is 30,000. Cepat, faster, Mabilis. Yes, Mabilis. So total ordering cost. Hello, total ordering cost. Come on, come on, come on, come on. What is it? Now 180 divided by what? 30,000 times what? $150 per order. How much is it? How much is your ordering cost? 900 per annum. Holding costs 0 plus 30,000 by 2 times what? 8% times $3 times 98%. Why 98%? Why 98%? Yes, because of 2%. It's no more $3 because you're getting 2% discount. Okay, so it's no more $3. So you have to reduce by the 2%. So how much is this? 3528. Total purchase cost? How much? $183 again times 98%, 2% discount. Five to 9, 200. So what's the total cost? $533, 628. So what is your conclusion? How much do you want to order? The optimal reorder quantity should be a what? Should be what? Do you want to order 15,000 or 30,000? Should be 30,000 units per order or 6 orders per annum because your total cost is 533. Earlier one was how much? 543. This is cheaper, lower cost. So the optimal reorder quantity should be 30,000 units or 6 orders per annum. Okay, done? Can I move on? Yes, okay. So that is on your working capital. Okay, so I've included all the relevant topics. I've looked at operating cycle, I looked at some ratios, I looked at below or model cash management, factoring services, as well as inventory management. Okay, so investment appraisal. Okay, there's also article here. Okay, so this one talks about different methods. So the IRR has a number of weaknesses. So read up all the weaknesses here. What are the weaknesses of IRR? Okay. So your right. So the problem areas that you will in your exam is the inflation. You have to be careful to take into account or not to take into account inflation. Taxation, you have to be careful with taxation, whether tax is delayed or not. If there is a taxation, there's a very high chance you will have capital allowances. Okay. Working capital, be careful with the working capital. See whether it's only one inflow, one outflow, or whether there is what annual increase or decrease in working capital. Then you have to identify all your relevant, irrelevant cash flows. You have to be careful. You need to know what is relevant and what is irrelevant. You cannot simply include any cash flows, right? And then when you calculate your capital allowances, be aware that your there will be a balancing allowances or balancing charge at the end of the project life. So this is a simple what do you call format to calculate your NPV. Sales minus all your expenses, fixed costs, you get cash flow before tax, then you have tax, right? Then you have tax relief on capital allowances, residual value, then working capital and investments and all that. So this is the format. You must know the format. You don't know the format, then you're going to have a big problem. Right? Risk. You also have to take into account of risk. So there are, you can take by looking at sensitivity, scenario, risk adjusted or profitability analysis. Right. So this article talks about how do you take into account of risk. Okay. So one of the most common method is your sensitivity analysis, which is quite popular. So you need to know what are the advantages and disadvantages of using sensitivity analysis. Okay. All right. And then another one would be your probability analysis. Okay. So this article gives you examples and also talks about what are the weaknesses of ENP, expected net present value. Okay. So you also have, you can also use decision tree to identify, to take into account your risk and uncertainty. Okay, so let's look at this question. All right, REDAC has several investment projects to consider. So there's project 1, there's project 2, project 3, project 4. I've modified, okay, these questions to consider everything. So we're going to look at one by one. So part A, calculate the net present value of project 1. Comment on whether this project is financially acceptable. So let's look at project 1. This is an investment, new machinery to produce recently developed product. The cost of the machine payable immediately, 1.5. Payable immediately means how much? When is it? Year what? Yeah, year 0. And the scrap value measure end of 4 years expected to be 100,000. So there's a scrap value 100,000 at the end of the project. Capital also can be claimed on investment 25% reducing balance. Information on future returns. So we have volume, selling price, variable cost. Information must be adjusted to allow selling price inflation 4%. Variable cost inflation 2.5% per year. Fixed costs are wholly attributable to the project. Wholly attributable to the project means what? Relevant or not relevant? Huh? Wholly attributable, relevant or not? Wholly attributable to the project, so it is relevant. Already been adjusted for inflation. Pays tax 30% 1 year in arrears. So 1 year in arrears means what? Your tax is delayed or not delayed? Yes. So arrears means it is delayed. Working capital investment at the beginning of a amounts to 10% of sales for that year is required. All working capital will be recovered at the end of the project. Okay, so working capital is 10% of sales. That year is required. So I'm not going to look at project 2 or 3. Okay. We have other information. What other information? Nominal before tax is 12%. Nominal after tax is 7%. So project 1, right? For project 1, what's that? Tax is taken into account, correct not? So cost of capital will be what? 7%. We take after tax, weighted average. If you do not take into account of tax, then you use 12%. Understand or not? Okay. If you do not take into account of tax, then what's that? You take 12%. Since we are taking into account of tax, so we will use 7% as a cost of capital. Okay, so let's calculate NPV for project 1. So how many years project is this? How many years project? Four years. But we have one more year because what? Tax is delayed. As of now. So to make our life easier, I'm gonna do all my calculation in thousands. Okay, we do calculation a bit faster. So sales, we need to do a little bit of working. Variable costs, working too. Fixed costs, you no need to do any working because it is already been inflated. Excuse me. So 105, 115, 125, 125. Excuse me. Okay. What else we have after fixed costs? What do we have? Is there any other relevant cost after fixed costs? Huh? So we have cash flow before tax. Then we have tax what? 30%. What comes after tax? What item comes after tax? Format is very important. If you remember the format, you will avoid unnecessary mistakes. What comes after tax? Come on, people. Huh? You are struggling to do NPV calculation for a simple question like project 1. Telling you, you are in a very, very difficult position. Hello, I'm still waiting. Dividend, oh my God, how can you include dividend? Dividend and interest will never appear in your NPV calculation. That's a very, very fundamental, very big fundamental mistake, including dividend and interest in your NPV calculation. That's a very, very big mistake. Cash flow after tax? No, not cash flow. Tax savings on what, Francis? What tax savings are you talking about? Cost of the machinery is a bit later, Mary. What tax savings are you talking about, Francis? Oh my God. This is a very, very important topic, investment appraisal, and you people still don't know how to calculate NPV means what is going to happen to y'all. How are y'all going to pass your FM paper? It's going to be a disaster, man. It's going to be a very, very big disaster. Scrap value will come a bit later. Something comes here, something comes here, then you can talk about investment here, which is 1.5 million. You can also include your scrap value one shot, 100,000. Two more items comes before your investment and scrap value. What is that? Depreciation. Oh my God! How can you say depreciation? Depreciation is a non-cash item. Tax relief on capital allowances. Working 3. What comes next after tax relief? What's next? Huh? Yeah. This is a very, very difficult, very, very problematic already. Huh? You don't know your NPV format. And you want to sit for FM paper. This doesn't look good. What's next after tax relief on capital allowances? Ayo, what inflation, Jennifer? What do you mean by inflation? How can you put inflation? What is the inflation? Is a what? Increase in prices. It's not an expenditure. It's not a cash flow. Inflation is a term used to describe increase in prices for goods and services. Come on, people. I'm very, very disappointed. I'm very disappointed yesterday. I'm very disappointed today. You're spending you're spend your valuable weekends, and then this is the feedback I get. I'm spending my weekend. You are spending your weekend sitting down, listening, putting your effort. Yes, thank you, Jojo. Working capital. What's the point sitting and listening to for spending your weekends with me, but you don't, end of the day, you don't revise, you don't check your notes, you don't do your homework, you don't practice. What's the point? So working 1. Your year 1 sales, 50 times what? 25. Inflation, 1.04. Year 2, 95. 25, 1.04 to the power of 2. Year 3, 4, 75. So what is your sales for year 1? How much? Can I have the figure? Okay, 1, 3. Year 2. Come on, year 2, Mablis. Year 2. Oh, selling price is wrong. Sorry, my selling price is wrong. My selling price in year 2 is 24. Sorry, mistake. 24, 23, 23. It's a different selling price. Yeah. Yeah, 2466. Okay, year 3, please. What's year 3? 3622. Year 4. 2018. So put it here. What is that? 132466 3622 2018. Can you calculate your working to now? Your variable costs? How much is your variable cost? 50,000. Times 10. Times what? 1.025. So how much? 5125. 513 lah, we round it up. What about year 2? How much year 2? 1098. Year 3. 1809. Year 4. 1035. Very good. Thank you, Jennifer. So we have 513, 1098, 1809. So what's your cash flow before tax? Can I confirm the cash flows before tax? Hello? Can I confirm the cash flow before tax? Huh? 68212531688 Okay. Where did I go? 201810. Okay. 858. Okay. So what is your tax? Year 1 tax, how many percent? 30%. Tax is 30%, yeah. How much? Year 1 tax, how much? Do you pay in year 1? Do you pay in year 1? No, you pay in what? Year 2, isn't it? Then year 2 tax, you will pay in year 3. And year 3 tax, you will pay in year 4. And year 4 tax, you will pay in year 5, 2, 5, 7. So what is the tax relief on capital allowances? I give you 2 minutes, calculate that now. Do your working 3. Alright, if you still don't know how to calculate capital allowances, right, sorry to say, you can say bye-bye to your FM. Calculating capital allowances is one of the simplest, easiest working you can do. So what's the tax relief? Year 1 CA, how much? What's the capital allowances for year 1? You say capital allowances is what? 25% reducing balance. So what is year 1 capital allowances? $375. So 30% tax relief. 30% tax relief is 113. And timing will be what? Tax is delayed. So year 2. Year 2 capital allowances. How much? Year 2, capital allowances, 281. Tax relief, 306. How you get 306 is 281. $84. So timing will be year 3. Year 3 capital allowances. How much? $211. Tax relief, 63. Timing, year 4. So your written down value, okay, is 633. All right. So your disposal is 100. So in year 4, there's a balancing what? The written down value is 633, but you sold it for 100,000. So there's a balancing what? What is it called? Balancing what? Yeah, 533. What is it called? Yes, balancing allowances. 533. With the tax relief 30%, so 160. This will be year 5. So 113, 84, 63. So nothing here, nothing here. 113, 84, 63, and 160. Now working capital, working for. So if you look at your sales, first year, how much is your sales for the first year? We calculated earlier, 1300. Working capital required. How much working capital required? 10% working capital required. So 130. Increase or decrease? $130. In which year? This will be in year 0. Because you need working capital at the beginning of the year. Read the question carefully. What it says, working capital investment at the beginning of the year, amounting 10% of sales for that year. is required. So your sales for the year, for the first year is 1.3 million. So you need 130. So at the beginning of the first year is year 0. So for the second year, what is your sales for the second year? We calculated 2466. So how much working capital do you need? 10%. 247. So how much do you have to invest? You already invested 130, so you have to invest 117. This will be in year 1. So what about third year? Third year sales is what? 3622. So investment 362. So how much do you add? 115 in year 2. And then for the fourth year sales, your fourth year sales is 2018. So 202. So what happens? So you will recover 160 in year 3. And then at the end of the project, recover all at the end of project. How much do you recover at the end of the project? How much at the end of the project? Hello? Come on, how much do you recover at the end of the project? What's the balance working capital to recover? You invest 130. Yes, 202. Thank you. So you can see your balance here. At the end of the day, you'll have 0 balance. Everything is fully recovered. That's around 160, 202. Okay, so 130, 117. So we have 130, 117, 115. Right, 160 and 202. So can I have the net cash flow now? So here will be 1630, 565. 1046. much we have? This is what is this? 717. Can I confirm? Please confirm the figures. Yeah. All right. 617. 717. Okay. All right. So at the discount 7%. All right. So calculate the NPV. So can I have NPV here? Can you calculate and tell me no? In thousands? So what's my NPV? $1,560. Can I confirm? Yeah, okay, 1560 positive. Huh? All right. Comment here will be what? So based on NPV analysis or evaluation, project 1 is financially beneficial. Project will increase company's value. And maximize shareholders' wealth. By how much? 1.56 million. Okay. Based on NPV, and project 1 is financially beneficial. The project will increase company's value, maximize shareholders' wealth. By how much? 1.56 million. Okay? Follow? Hello, any question? Guys, okay, right? All right, so we'll have a lunch break. I'll see you back. Okay. All right, I'll see you at, yeah. Okay, 1 o'clock. Thank you. See you later. We'll continue on project 2 and so on.